Hi, this is Gary Kamen, Trader and Educational Director at the Commodity Research Bureau and Editor of Trends and Futures. The charts and pricing in the following video were taken as of close August 19th, 2011. Gold dropped $100 the trading week of August 22nd, 2011. So listen carefully. You're about to start a journey into the business we call gold and the condition Clint Eastwood sang about in Paint Your Wagon. Gold fever. I know, don't quit my day job. So before we get started, thousands of years ago, the Greeks had a story about gold. It was a story about King Midas. King Midas was granted a wish from the Greek god Dionysus. The wish was everything he touched would turn to gold. All the flowers and the trees he touched turned to gold. All the food he ate turned to gold. His daughter turned to gold when he touched her. His bed, his clothes, his friends. Eventually the whole palace was gold. King Midas cried out to the god Dionysus, "Please take back this golden touch." Because the king was ashamed and very sad, the god took pity on him and granted his request. Instantly, King Midas was poorer than he had been, but richer, he felt, in the things that really count. So even back then, Greeks warned of gold fever. What you're looking at right now are the top 11 gold holdings. This is data from the World Gold Council as of December 2010. As you can see, the United States is the number one gold holder with 8,133.5 tons of gold. And it goes down to the Netherlands, which is number 11 at 612.5 tons of gold. You'll notice two groups here are not countries, the IMF with 2,814 tons of gold and the ETF GLD, which was created in November 2004. And they are currently the sixth largest gold holder in the world with 1,290.8 tons of gold. If you go through the whole list of countries, and I do believe there's 190 of them, countries that have 25 tons, 30 tons, 100 tons, it adds up. So the largest gold ETF is GLD. Not only are they the largest gold ETF, they're the largest ETF. And you can see the picture here from their website of what looks to be their warehouse of gold. They have 1,290.76 tons of gold. In ounces, that's 41,499,269,410. That's a big number. That's enough gold to give everyone on the planet, which the population now is at 7 billion, almost 6 ounces of gold each. In US dollars, the value of this gold is 76,673,809,508, and don't forget the 35 cents. So you can find this information right on the home page of the Spider ETF GLD. And let's take a look at the gold supply. And this data is from the World Gold Council. The supply of gold has been relatively constant since 1999. Gold has been mined and refined at an average rate of 2,600 tons. It is currently estimated that there's approximately 160,000 tons of gold above ground. Where it is known about with reasonable confidence, that number represents 20 to 25% of unmined gold. South Africa may have 50% of the world's known stock of unmined gold. With technology's help, there have been numerous new gold mines uncovered over the past 5 years. It is estimated that gold reserves make up 30,000 tons. Jewelry ownership, 80 to 90,000 tons. India is the largest consumer of gold jewelry. And private ownership of bullion and coins at 20 to 30,000 tons. Since China extended private ownership rights in gold, it is expected that China will overtake India in gold consumption by 2014. In 2007, China overtook South Africa, the US, and Australia as the world's largest gold producer. So what about gold demand? Again, this is from the World Gold Council. In 2000, gold demand for jewelry was at 70%, investment was at 20%, and industrial was at 10%. By 2005, that had changed to 60, 30, and 10. And as of 2010, the demand in jewelry is at 50%, investment demand is at 40%, and industrial demand is still at 10%. Now, industrial use for gold hasn't changed much in 10 years. However, in silver, 50% of what we take out of the ground in silver is used by industry. So let's look at gold futures. And let's look at the last decade. And I call this the Great Gold Rush of 2000. In 2000, gold was trading below $300 an ounce. We have Wall Street introducing GLD in November 2004, and this is where investment demand comes from. And you see how gold took a nice ride up. 2008 market crash. Yes, gold goes with it. We're over $1,000 here, and we're below $700 here. Now this is on a monthly chart. If you looked at the US dollar index chart, the US dollar hit its all-time low back here at 71.55, and very quickly in that year, I think reached up to 89. Why did that happen? Because during this crisis, everyone turned to the US dollar. That's interesting, because after that happened, look at gold and look at investment demand. So what's it all about with gold futures? And this comes from Trends in Futures. You have the contract specs here where it's traded on the COMEX exchange, which is now owned by the Chicago Mercantile Exchange. A trading unit is 100 troy ounces of gold. There's no daily limit. Here's the trading hours of the pit session, which is 7:20 a.m. to 12:30 p.m. and the electronic session, which is 5 p.m. the night before to 4:15 p.m. that day. Value of one futures unit is $100. Value of one options unit is $100. So let's look at the gold investor and the gold trader. From the previous chart, we saw how gold was trading in 2000 at $300 an ounce. So if you would have purchased an ounce then, your 1 ounce would be worth $1,880 today. Nice profit at $1,580. Now let's say you purchased 100 ounces of gold in 2000 at $300 an ounce. Your cost would have been $30,000. Today, the 100 ounces would be worth $188,000, a profit of $158,000. That would be an approximate average increase of $14,300 per year over 11 years. This is investing in gold. Taking the same example, you would like to control 100 ounces of gold back in 2000 at $300 an ounce. First, right now, as of August 19, 2011, the CME COMEX Gold initial margin is $7,425 and maintenance is $5,500. However, going back to 2000, your initial margin would have been approximately $1,170 and maintenance would have been $870. So for $28,830 less than the above example, you could have controlled the same amount of gold, giving you the freedom to buy long and sell short at times to capitalize on gold's wild ride up, pocketing cash on the ride. The investor would have to sell his gold to cash in. Also, if you're holding gold, why not use the futures market to hedge if gold does drop at times? And it will. What about GLD? GLD was introduced to the investment community back in November 2004. It currently is the largest physical asset ETF and also the largest ETF. When you buy one share of GLD, you are purchasing 1/10 of an ounce of gold. So 10 shares would be an ounce, and 1,000 shares would be 100 ounces. As of close Friday, GLD closed at $179.95. The 1,000 shares, or 100 ounces, would be worth $179,950. The same closing day, cash gold closed at $1,851.68 an ounce. If you held 100 ounces of hard gold, it would be worth $185,168. Now, GLD was not around in 2000, but let's say it was. In the above example, the difference of the cash gold to the ETF is approximately 2.9%. So at $300 an ounce, one share of GLD would have cost $29.13. Here, the 1,000 shares would have cost $29,130. And what you would have is paper saying you own 100 ounces of gold. Do not bother knocking on the door of GLD and asking for your 100 ounces of hard gold. You won't get it. That's not how this works. Now remember the gold warehouse of GLD on the previous screen? Well, what do you think GLD does with all the physical gold they own? The only way GLD stock goes up is if the price of gold goes up. The basic logic in futures is you have buyers and sellers. Where you have one contract long, you'll have to have one contract short. Again, we're looking at futures, not options. So let's look deeper into futures. And ready for this? Who's selling gold at $1,800 an ounce? After all, everyone's saying buy, buy, buy. I hope Glenn Beck is listening. So before we look at that, let's see where we are in trends in futures. Again, this is as of close August 19, 2011. At Trends in Futures, a long recommendation was issued on July 13th at 1587.50. As of close Friday, August 19th, which was 1852.20, Open trade equity is at $26,470. That's based on one contract. If you don't know how to read these technical indicators, I highly recommend you use trends and futures to educate yourself and learn how to be successful in trading futures. So what about big money? In gold, in the week ending Friday, August 19th, 2011, we saw open interest at 107,000. And in the Commitment of Traders Legacy Report, which is the older three-line report, we see commercials long, 160,562 contracts. Short, 409,409 contracts. As commercials and large specs are both long and short. So this is a net position for commercials of 248,847 contracts short. The non-commercial positions came in at 263,954 contracts long and 63,868 contracts short for a net position of 200,086 contracts long. In September 2009, the CFTC finally came out with the new disaggregated report separating the swap dealers from commercials and adding managed money and other reportables. In the new disaggregated report, there are no more small spec. So on Friday, August 19th, 2011, producers were 79,163 contracts long, 267,985 contracts short, for a net short position of 188,822 contracts. Swap dealers were 63,910 contracts long and 123,935 contracts short, for a net position of 60,025 contracts short. Now, to see how the legacy report correlates to the new report, if you take this number here and add to this number here, that's the net short position of producers and the net short position of swap dealers, you'll come to this net short position of commercials. And managed money came in at 213,261 contracts long, 13,386 contracts short, for a net long position of 199,875 contracts. This new report is much more transparent. In the latest report at the Bank of International Settlements for the second half of 2010, the swaps market had a notional value of, that's a big number, that's $601 trillion. And if this number doubles, which it did the past 5 years, what's after $1 trillion? So for me, I think it's vital to see how that much money is moving around the markets and is not hidden within the commercial category. The COT information is useless unless you can see a historical presentation. 1 year so you can see 52-week extreme highs and lows, and 3 years graphed on a weekly chart will give you the best view of how these moves affect price. So are the swap dealers speculators or hedgers? Well, in most markets they are speculators. However, in gold they're not. Remember GLD? Let's see the weekly chart. Here you see the gold weekly chart that goes back to 2007. You see 2007, 2006 right in here. Gold was trading at $600 an ounce. And it was riding between $600 and $700. Then all of a sudden you saw something interesting take place. You saw in the old report, large spec, buying, and commercial selling. But what was actually taking place? Actually what was happening is managed money was buying. Swap dealers and true producers were selling right in here. And you see how the market came down as liquidation took place. Again, these are the two same reports, but they're correlated. Here's managed money selling their longs, and here's true commercials and swap dealers buying back their shorts. And look how close they got here, right in here. And then comes late 2009, gold's trading at $700, $800 right in here. And what happens? More selling, more buying. And we see that down here by managed money, the swap dealers, and producers, or what I call true commercials. And look at this drive, all the way up. Buying, selling, and here's the swap dealers. They're hedging right along with the producers. Look at that. And the price of gold skyrockets, as you can see from this chart. So if anyone out there thinks these high prices of gold have nothing to do with speculation, show them the video. Now, Warren Buffett and gold. You may have heard this before, but Warren Buffett was asked about gold and he said, and I quote, "Gold gets dug out of the ground in Africa or someplace, then we melt it down dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone who's watching from Mars would be scratching their head. Now, while I don't know if we have anything in common, I'm guessing he likes Dairy Queen by the picture of him. So we have that in common. As a matter of fact, what he's eating is my favorite sundae at Dairy Queen. It looks like he's eating something with hot fudge, vanilla ice cream, and nuts. Lots of nuts. But also his take on gold. I grew up in the jewelry business. My father was a watchmaker from Europe. He was authorized to fix Rolex, Patek Philippe, all the expensive mechanical watches. His entire life, he wore a mechanical watch he bought at a PX in El Paso, Texas, before being shipped out to fight in World War II to New Guinea and the Philippines. It cost him $12. Now, he used to buy scrap gold. Broken rings, chains, watch cases, bands, and yes, even teeth. I remember when gold hit $850 back in 1980, he stopped buying gold. He did not feel gold was worth $850. When gold prices dropped, he started buying again. He has passed, but I still have the scrap. Will I sell it anytime soon? No. Not because I think gold prices are going up, and I'm sure they will, but because it was my dad's. Just like his workbench that he used for 50 years, I will never sell that either. So while I won't be selling or buying hard gold, I will be trading gold futures, using trends and futures to catch the moves up and the inevitable moves down. So if you're not using trends and futures, use it. You'll find it as useful in catching winning trades as I do. Once again, my name is Gary Kamen. Thanks for listening to my rant on gold. And until we meet again, the most important thing is for you to be well, then you could trade well and follow the trends.